Hi, and welcome to this video. I'm going to work a problem that is rental income, and it's going to cover all of the things that we need to understand. The hardest part about this is organizing our work so that we can keep track of where we are and what we're doing. So let's get started. Okay, so this is a problem, and I picked the longest, hardest problem on purpose so that I can do everything and show everything. Alright, so we have Chi, he's single, age 40, he has the following income and expenses. The first thing that we're going to focus on is the rental income and rental expenses. So let's just pull those out of the problem, and then we'll go and take a look at the rules about those. So we have rental of vacation home, and we can see that for that he received $4,000. So that's our rental income that we're considering. And then it says that he rented it 60 days and used it personally 60 days. So we're just going to make a note, rented days, personal days, and that is 60 and 60, which is a total of 120. We already know that's half and half, 50%, but we want to just make a habit of doing it like this. So we can say 60 divided by the total, which is 50%, and 60 divided by the total, which is 50%. Okay, and then we've got some municipal bond interest that'll be used later, dividend that'll be used later. I'm just looking for the expenses related to this vacation home. So interest on vacation home. All right, so the interest on the vacation home is $47.58. And then we have property tax on vacation home, $1,098. Then we have utilities and maintenance on vacation home, and that is $2,600. And then we have depreciation on vacation home. So I skipped all the things that did not have to do with my vacation home. Next, I'm going to take a look at the rules. So I've copied the rules from our textbook onto this sheet right here. And it says that if the resident is rented for fewer than 15 days, okay, and it goes on, but that would be primarily personal use. That's not us because we rented it for 60 days. Primarily rental use, if the resident is rented for 15 days or more, we did, and is not used for personal purposes for more than 14 days or 10% of the total days, whichever is greater, then it's primarily rental use. Well, we used it for 60 days, which is more than 14 days, and the rental days were 60, and 10% of 60 is 6, and we also used it for more than that. So we do not fit this criteria either. We're not primarily rental use. So that must mean that we are personal/rental use. So let's read to be sure. If the resident is rented for 15 days or more, it was, and is used for personal purposes for more than the greater of 14 days or 10% of the days rented, it was, then we are personal rental use. In this case, the expenses must be allocated between personal days and rental days, and expenses are allowed only to the extent of rent income. All right, so it says expenses allowed to extent of rent income. That means no loss allowed. All right, and then it goes on to say if the residence is classified as personal rental and the expenses are deductible, then it must be deducted real estate taxes and mortgage interest first, then maintenance, utilities, and insurance, and depreciation last. I'm going to show you why that's important, but just keep that in mind that we have to go in that order to get to our loss, if we have a loss. And then we have to take note of this down here. There are two different ways to allocate. There's the IRS method, which we usually default to in Cengage, and it says that real estate taxes and mortgage are allocated on total days of use. And then the court method, which is in the first part of this paragraph, says that real estate taxes and mortgage interest accrue ratably over the year, so you do them over 365. So the only difference in this is that for real estate and mortgage only, that's all we're talking about. If you do the IRS method, then you're going to allocate based on the number of days. So for us, it'd be that 60 over 360. I'm sorry, I said that wrong. 60 over 120. But if you do it the court method, then it would be 60 over 365. And so what this problem asks us to do is do it both ways and see which one's more favorable. And so we'll do that and see how it comes out. All right, going back to our problem now. So the first question says, what is our net income from the vacation home? Well, we know we can't take a loss, but we have to allocate it in the right order. So the order that it has to be in is mortgage interest and taxes, then other, finally depreciation. All right, so let's do that. So our rental income is $4,000. And then our interest on our vacation home. All right, first we'll do the IRS method. So the IRS method would be the 60 days over 365 days. So we'll divide that, and it would get to be that number right there. So I'm going to say equals interest times 60 over 365 equals interest times that. And I get 782. Then I'm going to do the same thing for property tax using that IRS method. So that's going to be property tax times 60 over 365. And then moving into utilities, I'm going to use the regular method, which is the method for every court and IRS, which is going to be utilities times the 60 over 120. So that's 50%. And then I need to wait and see if I'm at a loss yet. So I've got 4,000 minus my deduction for the interest, minus my deduction for property tax, minus my deduction for utilities. Right now I'm at 1737. I can't go below 0. So even though I might want to depreciate more, let's see how much depreciation I have. 3,500 times 50% is how much I want to do. 1750, but I can't do 1750. All I can do is 1737 because I cannot go below 1737. So I'm just going to plug that in, and I'm going to see that that gets me to a net income of 0. Didn't take a loss because I'm not allowed. I stopped at my 0. Probably going to have some rounding here, but basically it's 0, 36 cents. We mean 1737.37. There. All right, so that is using my order rules to get me down to net income. So once I know what I've deducted for my vacation home, then I can start working on, okay, what can I take on my personal income tax form for my itemized deductions. So itemized deductions. Let's do the straightforward one first. I know that I have interest on my primary home. I can take all of that. And looking over on the left, I can see that that's 8,400. Then I can take interest on property tax on home. That's my primary residence. I can take all of that. I don't have to think anything about that. That's 2,200. Then I can take the better of state income tax or state sales tax. So state income tax is 3,300, state sales tax is 900. So because 3,300 is better, I'm going to take state income tax. So I'm going to take $3,300. All right, none of that has to do with my rental property here. Tax return preparation fee, that was deductible before 2018, but they did away with the miscellaneous 2% itemized deduction, so that's gone, no deduction. And nothing else is an itemized deduction. All right, so that is my itemized deductions other than my rental home. Now let's see how much itemized deductions I can have on that rental home. So I had interest on vacation home, and it was a total of $47.58. So it was $47.58. But I already used $782 on it. So I am going to subtract out the $782, and that's how much I can take on my personal itemized now. Remember, these up here are not itemized. These are for AGI to reduce my rental income. Now I'm talking about my itemized deductions. All right, so then I have my my property tax on vacation home. All right, so the total property tax on vacation home was $10,098. So I start with that, but then I have to subtract out what I was able to take as a 4 AGI. So I'm going to subtract out this $180, and then I have that. I can never take utilities or depreciation as an itemized deduction. All right, then we're going to look through here and find any other itemized deductions. And I see charitable contributions, and that is $1,100. So then I'm just going to add those itemized deductions together, and if I round, I get $19,893. So those are my itemized deductions. So my net income from vacation home is 0. My itemized deductions is $19,893. And so my taxable income, we're going to have to do a calculation for that, is going to be my salary, which is $43,000. Then my rental income, which is the $4,000, minus my rental deductions, which are $4,000, because we had to take all of them to get to it, to get to a 0. So we netted all that out. All right, and so then municipal bond interest is non-taxable, so I'm not going to add that. Dividends from GE, that is taxable. So I'm going to add that as my income. That's $400. All right, and then we already took care of all of those, so I don't see any other 4 AGIs. So I'm going to net all this together. And then my itemized deductions are $19,893. This person is single. We're doing 2021. So we should take the itemized deductions because that's better than standard. So taxable income should be $23,507 if we round, and that is the correct answer. Now it asks us to do the most favorable one, and so we did the IRS method because that gave us the most favorable itemized deductions. If we did the court method, what that would have done is it would have given us more interest on vacation home and property tax to deduct against our 4 AGI deductions, but then that would have left it, and we got down to 0 no matter what, and then that would have left us with 0, or I'm sorry, not 0, sorry, my cat's distracting me right now. That would have left us with less itemized deductions down here, which would not have been good because we can't take a loss anyway. So we don't want to waste our good itemized deductions on our 4 AGI up here. And so it's going to be more beneficial to do the IRS method if we're going to be in a net loss situation anyway and we can't take that net loss. That gives us more itemized deductions. So let me know if you have any questions, and thank you for watching.